All right, let's jump straight into this explainer. Today, we're demystifying the covered call options strategy. If you want to generate consistent income and strategically manage your long-term stock positions, mastering this is absolutely crucial.
You know, if you're actively managing a long-term portfolio, you've probably stared at a stagnant stock position and thought, man, I really wish this was doing more for me right now. We have all been there. Well, what if you could essentially create your own dividend stream from the stocks you already hold? Instead of just waiting around and hoping for capital appreciation, collecting an options premium is basically the ultimate solution to make your existing assets work so much harder for you.
So here's our roadmap for getting there. First, we'll cover what a covered call actually is. Then, we'll look at the income and downside protection benefits. After that, we'll dive into choosing your strike price, selecting an expiration date, and finally, how to actually manage those live positions.
Okay, starting right off with Section 1, what is a covered call? The fundamentals.
Before we get into the weeds with any advanced data, we've got to establish the absolute basics. You can think of this strategy kind of like renting out a house you already own to collect income. To do that, there are two mandatory steps. Step 1, you literally must own at least 100 shares of a stock. Step 2, you short or sell a call option against those exact shares. I really want to emphasize this foundational rule because without those 100 shares acting as your cover, you're exposing yourself to a massive amount of risk. But by owning the shares up front, your risk profile is completely secured. Now, when you sell that call option, you have to choose a strike price. The strike price is really just the set price where the call option buyer is allowed to purchase your 100 shares of stock at expiration. So the big takeaway here is that you're essentially agreeing to a predetermined selling price for your stock, completely regardless of how high the overall market happens to go. When you combine owning the stock, where obviously you want the price to go up, with shorting a call option, where you want the option's value to go down, you're creating a highly specific target. To maximize your money here without getting assigned and forced to sell those shares, you want the stock price to climb right up to your chosen strike price, and ideally sit just below it at expiration. That is the absolute perfect scenario. You keep your shares, and you keep all the premium.
Now that we've got the what down, let's move on to the why in Section 2, Income and Downside Protection. Let's see how this builds a vastly superior risk and reward profile.
Take a look at this historical simulation. Let's say you buy 100 shares of a stock at $100 a share. That's a $10,000 total investment. Now, imagine selling a covered call against those shares every 30 days, and you're collecting $500 in monthly premium. If you do this successfully for 5 consecutive months, letting those options expire worthless each time, you've just made $2,500 in pure, tangible profit. Think about that. You are practically creating your own high-yield dividend stream right out of your existing holdings. But as we know, there is absolutely no free lunch in the market. Here's the core trade-off you're making. On one hand, you get better profitability at any stock price below your strike price simply because of that upfront premium you collected. It gives you a real mathematical cushion, some actual downside protection. On the flip side, you are giving up your unlimited upside profit potential. If that stock suddenly rockets to the moon, well, your profits are strictly capped at your strike price. You're essentially trading infinite, unlikely potential for immediate, guaranteed cash.
All right, let's get a bit more tactical with Section 3, choosing your strike price. How do you actually find the right level?
I absolutely love this piece of practical wisdom straight from the r/options community over on Reddit. Make strike price high enough to be unlikely to be hit. It sounds incredibly simple, right? But it perfectly hits the nail on the head for everyday investors using this strategy. Most folks want to avoid unwanted assignment. They're selling these options to generate supplementary income, not because they're eager to liquidate their long-term holdings.
Your strike selection also needs to be deeply tied to your market outlook. For example, consider how the investment team at Vantage Financial approaches this. If they have a neutral or a bearish outlook, meaning they think the market's going to stay flat or drop, they'll sell covered calls with a strike price much closer to the actual stock price. Why? To collect a higher premium. Conversely, if they're bullish, they sell at a much higher strike price. Yes, the premium is lower, but it retains way more of that upside potential if the stock climbs.
Moving right along to Section 4, Selecting an Expiration Date. Time is literally money in the options world, and picking the right time frame is just as vital as picking the strike.
Many covered call traders frame the 30 to 60-day window as the absolute sweet spot, and here's why. Options experience fast time decay as they get closer to expiration. And since you are the seller, this rapid decay works directly in your favor, all while still letting you select strikes that are decently out of the money. If you go with much longer-term options, that time decay is painfully slow. You just end up tying up your capital and your shares, waiting entirely too long for the whole shebang to resolve.
If we look at this comparison from Fidelity, you can really see how shorter-term expirations offer the absolute best exposure to that favorable time decay. They allow for higher overall returns if you're actively managing and continually rolling them. But keep in mind, they do come with higher gamma risk. Longer-term options, they give you more upfront premium and better initial downside protection, sure. But your money gets locked in with a much lower exposure to that beneficial decay. Honestly, it all comes down to your personal trading objective.
Which brings us to our final stage, Section 5, How to Manage Positions. What actually happens when Expiration Friday rolls around?
Basically, you have 3 core ways to manage a live trade. Number 1, you can just leave it alone, let it expire completely worthless, or just allow the shares to be assigned and sold. Number 2, you can close the strategy altogether by unwinding the shares and buying back the short call. Or number 3, you can adjust the strategy. This means closing the calls, keeping your shares, and executing what's called a rollout.
Let's make sure we're completely clear on that last point. Rolling is defined as adjusting the strategy by buying to close your current short call and simultaneously selling to open a new one at a later expiration date and potentially at a totally different strike price. The really crucial takeaway here is that rolling is an incredibly powerful defense mechanism if a stock starts behaving a bit differently than you initially expected.
Think about what a rollout actually looks like in practice on a standard trading interface. Right from a single drop-down menu in a live options chain, the system just allows you to roll. You can instantly push that option's expiration out to the next month, tweak the strike price up or down based on current market conditions, and ideally, collect an additional net credit. It really makes advanced management super practical and accessible for pretty much anyone.
So, we've seen how covered calls combine the 100 shares you already own with selling an option to generate real, tangible income, offer downside protection, and bring a whole new level of control to your investments. The mechanics are beautifully structured, but the execution? That's entirely up to you. So how will you integrate covered calls into your own long-term portfolio outlook? Are you going to keep letting those shares sit idle, or are you ready to start writing covered calls and actually putting your portfolio to work?